These are the three main risks that investors need to be paying attention to in 2023. They are important, so pay attention. Ivo Pezzuto is the professor of economics and digital transformation at the International School of Management in Paris. Welcome back to the show, Ivo. Always a pleasure to have you.
Hello. Hi, David. Good morning. Good afternoon to everybody. Pleasure to be here.
Pleasure to have you. Before we talk about your three main risks, very important to watch out for and discuss, I want to talk about some current events coming out of Europe. We just had a war in Ukraine that's still ongoing. Now there's talk of a possibility of a new war, Kosovo and Serbia. Just going to read a paragraph of an article that came in from the BBC not too long ago. Kosovo ethnic Serbs began erecting roadblocks on the 10th of December in protest at the arrest of an ex-police officer. Since then, tensions have been escalating. Nothing has happened yet, violently, thankfully. But there are fears now that we may see another conflict in the region, and of course, a full-blown one. Reminds people of the Yugoslav war in the early 90s, which saw at least 140,000 people killed. Terrible incident. Could we see that again? Will we?
I think, thank you for the question. David, I don't think so. I don't think that we're going to see something like that anytime soon, or at least not as serious, in the sense that the last thing that Europe can handle now, and I would say also NATO and US, is another geopolitical instability and conflict in Europe while we have this Ukraine conflict. So, and the spreading of other tensions. No, I don't think so. And positively, one good thing is that from the recent news, we received the message that despite these roadblocks and barricades, that the Serbian, ethnical Serbian group, people living in this, minorities living in this part of Kosovo, have set up to complain about, arrests of a policeman, and a few weeks ago, they had a problem with the license plates. They didn't want to use the Kosovo license plates, but the Serbia. This is basically a problem of two countries that are bordering countries with different ethnic and religious groups, and the fact that the Kosovo went independent in 2008 from Serbia, they never really accepted. So these people living on the other side of the border, on the Kosovo side, the Serbian people living there, they don't want to accept the fact that they're part of Kosovo. So they have all kinds of problems. Despite the peacemaking force from NATO, the KFOR, in trying to mitigate this stuff, they have since many years this trouble. The good news is that it looks like, thanks to the intervention of US, European Union, and others to mediate, they are trying to de-escalate the tensions between Serbia and Kosovo, these two bordering countries in the Balkans. And the latest news is indicate that barricades will soon be removed. That's one of the declarations they said. So basically, yeah, there have been tensions a lot because of this historical tensions between two groups, and also the fact that, as you know, Serbia has voted against the sanctions on Russia back in when there was the invasion. So there are some links there that complicates the situation. But by and large, it's nothing's happening so far. Or even if it happens, it probably will not be a big escalation, because at this point in time, it's difficult to accept for the stability of Europe.
Okay, that's a great analysis, Ivo. But the Serbian army, according to this article, has said that it is at the highest level of combat readiness in many years. Is this that's not a concern?
Yes, of course, it's a concern. It's basically saying, we hear something that sounds similar to what we heard in Russia. When they said, you are not treating well our people in your country, the Russian people, the Russian-speaking people in that part of Ukraine. Here we hear the same thing in bordering countries, where they say there are some Serbian ethnic Serbian people living in the north of Kosovo municipalities, and they don't want to recognize Kosovo independence and rules and stuff like that. So, and since there may be some mistreatments, as they claim, we might intervene with force, with this combat readiness. I think it's a stand. It's basically it's an approach from Serbia to show that they are very serious about this. We don't think, honestly, that given the situation, anytime soon we will see their position, to change. They are firmly entrenched on both sides, but we will see some strong attempts from the, U.S., Europe, NATO, and other peacemaking forces to de-escalate and to mediate as much as possible. We cannot afford another conflict widening in Europe.
The final question on this, and we'll move on to other topics. Now, Ivo, it does say again once more in the article that attempts by the European Union, NATO, which has peacekeeping troops deployed in Kosovo, and the U.S. to mediate the situation had failed to make a diplomatic breakthrough. This is so far. Like you said, mediation is very important. So far, their efforts have failed. What's next?
I don't expect any things to be solved because these are long-term tensions. They go
Is the U.S. going to take sides? You think the U.S. going to take sides?
No, I don't think that they're going to take sides. I just think that both these countries, Kosovo and Serbia, ideally, they look forward to eventually join the EU. So I probably one day, sooner or later, better sooner than later, they will do it. And that being part of Europe will require, following the rules of Europe and integrating themselves in the European Union. So that would be a change maker. Would probably satisfy both to be part of Europe sooner or later. By the way, for example, Croatia, which is another country in the Baltic region, is joining the Euro in January 2023. That means in a few days. That means it's going to be the 20th country to use the euro. In Europe, we have 27 countries after UK did the Brexit. Now we used to be 28. Now we have 27. And 20 of this country with Croatia are using the euro within the 27. So Croatia is going to be number 20, and it's great news because this means a country from the country from the Balkans, the same area where Serbia and Kosovo come from. It's not only part of the European Union, but it's also within the euro. So I think this is going to be a good incentive for these two countries to come to terms with the fact they have to be more integrated with each other within Europe moving forward.
All right, so we'll keep an eye on that development, but no real risk for the moment, according to you, Ivo. Let's talk about your real risks then. You have 3 of them for us. Please outline them, and then we can go into them in a bit more detail.
Absolutely. Just to end that, no real risk of a big escalation.
Big escalation, yes.
Little things, but not big escalation as far as I can see.
Okay.
The other 3 elements are, one, it's the central banks, the big topic of the moment. Hard landing or soft landing? Will they crash the system with rate hikes and balance sheet unwinding, or will they will tame inflation finally without causing much consequence, much damage? And the other one is, of course, the energy shortage, energy crisis we experience in a number of countries, especially in Europe, or at least challenges. And then we talk about housing and something else. All
right, so hard landing versus soft landing, energy shortage, and housing. Big topics that affect everybody across the world. The energy shortage crisis, you're talking specifically about Europe. We'll get to that. So first, hard landing versus soft landing. Yes, in the U.S., where our audience is based, I'm in Canada. That's a big topic as well. I suppose all over the world. I'll keep this question simple, Ivo, because we know central banks all around the world are tightening policy in one form or another. The U.S. especially, 7 rate hikes so far this year, with more expected in 2023. Will the U.S. central bank, the Federal Reserve, cause a severe recession with their monetary tightening?
Well, I don't think they will cause a severe recession, personally, based on the data that we have, in the sense that before they do it, they will probably either stop and reverse the process, or when they start creating some real damage, they will somehow move in a U-turn type of a situation. I mean, they are taking some bold decisions and taking some risks because, when you have a high level inflation, it's inevitable that if you want to mitigate, tame the inflation, you have to do something bold. But since they're not doing it in a reckless way, they might do some damage, but I don't think it's going to be so devastating, like massive consequence, because they can always reverse, or they can always stop, they can always slow down the process of hiking. So that's my, that doesn't mean that in some weaker part of the economy, shadow banking or more opaque part of the market, more illiquid part of the market, you might have some side effects, as we saw in the crypto assets recently, when you drain liquidity. You might have some weaker part, or less regulated, less areas that have less support, less guarantee from collateral and stuff like that. So basically, the point is that at the moment, as you correctly said, inflation U.S., we talk about consumer price index, 7.1%. It's a good news because it was down from 7.7 in October. And the PCE, the measure that the central bank likes most, the Federal Reserve, was by around 4.7% from 5% in October. I'm talking about November. So slightly lower. We don't expect inflation to come down overnight, immediately, just because they're raising interest rates or unwinding the balance sheet. It will happen probably at a pace, in a progressive way. But there are signs that are it's improving. Especially in the U.S. more than Europe. They're ahead of the game in terms of taming the inflation. There are areas. So there is a good news. The good news is that in terms of PCE, we see improvements in taming the inflation. Of course, there are areas in which this is not moving the same direction yet. For example, now the policy rate is about is raising around 4.5%. The Federal Reserve, but the target is still far away. It's 2%. So they are committed. They have to do it. Their strategy, their target, it's around 2%. Price stability at inflation rate. So with an inflation rate that is headline 7%, you have to do something about it. They have to raise rates and reduce the liquidity. The point here is that in Europe, you have like about 10% inflation rate in November for the euro area. We have countries that go all the way to 20+% in the Baltic region. So that's real a serious issue. Although it might not be just driven by demand, but mostly also by energy component, there is an issue. So the point is, will they crash the system or not? Basically, the point is that all the indicators we have today, the early warning indicators, the leading indicators, the forward-looking indicators, they tell us, yes, if you go ahead like this, you will not only slow down the economy, not only fight inflation, but you might basically drive the economy into recession. So what we see today, if we look at typical indicators, for forward-looking, Conference Board Economic Index in the US, the OECD Confidence Index and Sentiment Indicators, or the PMI indicators, or the Output Index, or the others, even the yield curve, inverted yield curves we've seen between the 3 months treasuries and the 10-year, they all add in the direction that are below the threshold, the meaning they are going to a contraction of the economy, if not recession or even worse. So that's the direction if you keep on pushing this interest rate high. But just to give an example, the PMI for US composite index is 44.6. In Europe, Eurozone composite is 48. And in the global JP Morgan global composite is 48. So they are all below. They all point in that direction. But fortunately, and of course, some of the market participants are repricing risks and with what in spread. But the good news is that the governments also can contribute to do this. In other words, the fiscal.
Speaking of oil and supply disruptions, which you mentioned earlier, Russia bans oil sales to countries that accept price cap, according to this article I'm reading from CNBC. I'll just read the first paragraph. Russia announced on Tuesday it would ban oil sales to countries that abide by a price cap imposed this month by the West. Under the price cap, which took effect on December 5th, oil traders must promise not to pay above $60 per barrel for Russian seaborne oil to retain access to Western financing for such crucial aspects of global shipping as insurance. Is this even a problem? $60 price cap. Who is this going to affect?
Well, yeah, that's a good point. Again, here there is a signaling a message from the policymaker. On one side, there is the sanctions. There's additional sanctions on oil. The embargo from Europe on oil and the cap from the G7 plus Australia on the price of oil. They are meant to be combined. In other words, Europe has set an embargo on imports from the Russian oil seaborne export. But on the other side, they want to avoid that by causing this embargo, they would reduce the availability of oil in the market, the supply, and they would actually help Russia increase the price of oil. In other words, what happened last year was that by imposing sanctions on gas, natural gas, Russia sold less gas but a higher price. And so eventually Russia ended up in a better situation with only a minus 3% GDP in 2020. And because of rising energy prices, which improved the balance of payments of Russia and its currency and whatever. So they wanted to avoid another situation like that, which by sanctioning oil, they would actually have oil prices going up and Russia being better off at the end.
It just seems to me like a lot of political posturing, right? Because like you said, signaling. China currently is the largest buyer of oil from of Russia, right? And they're also selling it to India. So what does it matter that they're banning it to the West? They don't care. Putin doesn't care.
Yeah, the point is that, as you're right on this one, David, the point is that the sanction, this price cap on oil at $60 a barrel, sets at a price which is seems to be above the current price, although it's not official, but the current price that Russia is actually selling at a great discount from the market price, the oil to countries like India and China, which more or less goes around in the range of $42, $45, $48 a barrel. So in other words, this doesn't really affect. And the logic there is that since most of the insurance for shipments of oil come from European institutions, by setting this cap on insurance for the transport of oil by ship, the seaborne export of oil on the insurance, basically they also affect globally the insurance broking that can be available for shipments of oil around the world. So basically it's European plus Australia, but it's actually becoming global because the insurance companies are mostly based in Europe. So, but this, as you said, brings to the fact that this sanction doesn't stop Russia from offering oil through a shadow fleet of vessels. They continue to ship oil, seaborne oil, in different parts of the world, including, as you said, India and China, which have taken big advantage of this great discount. Anyway, below $60 a barrel, yes, they can be insured, they can be purchasing. It's just a way to basically keep the flow of oil in the market and keep Russian oil flowing to avert supply shortages, which would actually increase the price of oil, while at the same time limiting the transportation. Short term, not big problem, but we expect in the medium term they might have significant problems. And even some of the officials and the Russian government said we might have more higher deficits and stuff like that. But at the end of the day, as you said, even at $60 a barrel, the cap is close to the $70 a barrel price on which Russia 23 budget is based, which is raising doubts about the cap's effectiveness in limiting the Kremlin's fossil for revenue for the moment.
So Russian oil ban, not a huge problem. What could be a problem for our energy security then? What would cause a major energy shortage if that is a risk for you?
Well, I don't think there is.
There is no risk. Okay, all right.
No, because the other countries, the Saudis and the others, now they decided to keep the production. They could increase the production, but also, and there is a little trick over there. You probably read recently that U.S. has allowed more flexibility and the reopening of relationships in Venezuela, which is one of the world's largest reserves in the world. So Venezuela, which was one of the countries that were, on the sanctions list, now has been gradually, reaccepted, and it's opening up the relationship with this country, which has one of the largest oil reserves in the world, which means that worst case scenario, they know where to knock the door.
Okay, perfect. Housing market now. This is the last risk. The Case-Shiller Housing Price Index of the U.S. has been coming down. Not dramatically, not like 2008 yet, but it's been trickling down. We'll show a chart on the screen. Is this a concern? People are watching this right now wondering, Ivo, should I sell my home right now?
Well, it's inevitable that the tightening on the monetary policy, rate hikes, and all that stuff will eventually have an impact on housing. First of all, because housing has been exploding and growing in the past years, and also because of the ability to pay interest rates that constantly increase. This is mostly a problem for adjustable rates more than, if you have a fixed rate mortgage, that doesn't affect you too much. But for adjustable rates, that might be a problem. For example, in the US, the 30-year mortgage rates have surpassed 6%. So that's already something that's important, in that sense. So there is no doubt that the housing market in Canada, in US, in Australia, in other markets where they've grown significantly, they might be affected by these rate hikes, and they might slow down the market to they have a decline in home prices. There is no doubt. So and also it's very important. But I would say that given the importance of the housing market for the economy, housing market's a big piece of the economy. If you look into the consumer price index, the housing part, basic shelter has by far the biggest weighting in the CPI basket. So a continuous decline in the prices within 23 could really, offer the Fed the reason to claim victory over inflation. So in other words, until they reach the point of pain, I guess they have a mandate to fight inflation. They are about 7% CPI headline inflation. They have to go down close to 2%. We expect probably next year is going to be like 3.5% or a bit more.
3.5% inflation next year. All right.
Probably, or a bit more. But they have to go ahead. That might cause some problems in housing. So my suggestion would be basically not a problem if you have a fixed interest rate mortgage. It certainly is a problem if you have an adjustable rate, but there might be some pain. But I'm sure that given the size of the shelter of the housing market, before it becomes a real crash, a real problem, the central bank, the Federal Reserve, will revert or will slow down or will go all the way with a U-turn before creating a damage we've seen in 2008.
Well, let's hope they're keeping up with the data and they prevent that from happening. Yes.
If I can just say one thing, in 2000, what happened in 2008 is that, as you remember, interest rate went down to 1% in 2003 after the dot-com crisis and after the whole story we know, 9/11 and the war in Iraq, Afghanistan, whatever. So there was good policy to lower interest rate down to 1% because that's what you do when you have a recession. But then they raised interest rates when they had incoming inflation because of the massive subprime mortgages and mortgage-backed securities and collateralized debt obligations and the whole bubble with the housing bubble that we had between 2003, 2002, and 2008. And basically, because of this, fast expanding market and the huge incoming inflation from abroad, whatever, they had raised interest rates in those 2 years from 2004 to 2008. From 2004 to 2006, they raised the interest rate. They were down 1% in 2003, all the way to 5.25 in 2006. So that means that the speed of reverse, the speed of increase of the interest rate contributed to the problem of so they know that, they are aware of that, and they probably will not do that again.
Yeah. All right, well, let's assume that they are rational and they probably will not do that again. Ivo Pezzuto, thank you so much for your time today. Enlightening talk. I appreciate your time.
My pleasure. Thank you very much, and best wishes for the new year to everybody.
Best wishes for the holidays. Happy New Year, and thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.